And then the Tuesday, they brought me back in to meet with the partners. The Thursday, they took me out for drinks. Friday, they gave me an offer.
This episode of the BLUMExPodcast is brought to you by NetWin Place. NetWin Place is a co-working office space based in Scarborough. Co-working is quickly taking the working world by storm. Entrepreneurs of all sorts can take advantage of the many benefits offered by co-working spaces. NetWin Place is focused on small businesses, entrepreneurs, professionals, and anyone else in between. Their 10,000 square foot shared office space is ready to help anyone make their business dream a reality.
Cool. Anand.
Yes.
What's up, man?
What's up, man?
Good to have you on the podcast.
Thank
We've
you.
been talking about this for like 2 months now.
I'm happy it's finally happening.
Yeah. So, yeah, man, I want to talk to you because, like, through you, I got to understand the VC world a lot.
Okay.
Right? So, super glad we met.
Yes,
randomly.
we actually met here at UTSC
Yeah.
2 years ago now.
Was it 2 years?
I think 2 years
Something
ago.
like that.
It was Camel Chair fundraiser.
When Dr. Ravi gave the $2 million.
Yes.
Right? And then they were raising more capital.
And it was a room full of really old people, and then we were sitting like back to back at 2 different tables. And I turned around and I was like, "Oh, who's this other guy who kind of looks like me?" Hey, Ravi.
Yeah. And then when you dropped the fact that you work at a VC firm, my jaw really dropped because.
Yeah, and then you dropped the fact that you work with startups in an incubator, and I was like, "Oh, whoa, we should definitely work together on more things."
100%.
Yeah.
And like, it's funny how like close we've gotten since.
Yeah.
Right. I mean, I remember the first time we followed up and we met up. Right. We just literally talked about like so many different things. Right. You know, what's going on with startups, what's going on in the VC world, how all this stuff flows. Because back then, my biggest question mark was like exactly how companies raise the money that they do.
Yeah.
Right. Because I didn't understand it. So my last tech company, when I was trying to raise capital, it was such like a question mark. I was just shooting whatever I could, no system, no real understanding how to like properly secure equity, how to sell off parts of your company, how to structure deals, just going on the flow. And you know, that was not necessarily the best way to do it.
Yeah, there's definitely a right way to do it. Like you can approach fundraising with a process and be successful every time.
Yeah.
And you'll see like people who are like multiple time entrepreneurs that have successfully kind of seeded and funded, you know, a handful of companies that have, you know, taken it to Series A, Series B, C, some even IPO or exit at large multiples to what they initially started raising money at.
Yeah.
And you go, how are they successful at this time and time again? It's process. There's a way to do it right, for sure.
Absolutely. And like, I mean, from the outside looking in, especially for the VC world, the equity world, right, and the startup world in general, it just seems like this money is big sums of money are being signed all the time, and people talk about how it's such a scam, and other people look at it like it's like what, you know, like people don't understand like how is this thing raising $4 million? How is this thing raising $100,000? Right, when it's not addressing a certain market, it's like, you know, like what are the pieces involved in order to do that? And now, especially like within like the last 2-3 years, with resources are available through YouTube, through like online channel, you can actually go out and learn. People actually like tell you this.
Right.
But like 5-6 years ago, big question marks. So you started the VC world about what, 3 years now?
2 years.
2 years. Before that, you were at.
So I started. I guess we'll go back to Waterloo. I was in math and accounting at Waterloo. I got my first co-op job in audit at KPMG. Did that for a few years. Stuck with them till I graduated. Did my CA. Worked there full time for over a year as well. Yeah. And I got the opportunity to do a little secondment. So I was in their New Jersey office in a data analytics group for 6 months.
Secondment?
A secondment, yeah. So that's like staying within KPMG, but working in a different group in a different office.
Okay.
So I got to do that for 6 months, and I realized, hey, I really like this, like working with data, working with tech. Let me like see what opportunities are available in Toronto. And then I found this company called Vena Solutions. And so that's how I ended up at Vena. I was there for 2 years, had a great time, realized pretty quickly that, you know, SaaS companies are all about sales. And so I found an interesting position on the sales team in solutions consulting, or like pre-sales basically. So that's it's working on demos, working on like proof of concepts to help close a deal. After doing that, I got a chance to meet a few people in the VC space just because Vena was fundraising itself. And KJ at iGan was the first person to connect with me, sort of. He's another math Waterloo guy.
Yeah.
And after connecting with KJ on like a Friday, we just talked. They were looking for a new analyst. He called me in on the Monday for an interview.
So KJ was the principal of iGan?
Yes, yeah, he was a principal at the time. And then the Tuesday, they brought me back in to meet with the partners. The Thursday, they took me out for drinks. Friday, they gave me an offer, signed it back, and started 2 weeks later. So it all happened really fast.
Yeah. No, I can understand that. Like sometimes like life flows really quickly.
Yeah, exactly.
Right, and what was that step like? Because you never thought of going to VC world.
No,
Did you know what it was?
I loved what I was doing at Vena. I wanted to stay there for like the foreseeable future. It was funny, I'd run into a buddy of mine from Waterloo that was an entrepreneur and he had his own companies. And back then we talked about VC and things like that. Like while I was in school, I guess it was an interest area to some degree. He was like, hey, what happened to that? Like, are you still interested in those types of roles? You know, have you met any VCs in Toronto? Like, it's a pretty happening space. It's growing super fast. I was like, oh no, like I kind of let that stuff go, right? Like I didn't really pursue it afterwards. And then that is what like got me thinking again, like, hey, why'd I stop pursuing that? You know what I mean?
Yeah. So you became an associate at iGan.
Yes.
And iGan is a healthcare tech fund.
Yes.
Right, investing into Series A at like $3.5 million plus range.
So we're working our way up towards that. We're usually sort of pre-Series A. That'll be our first check. It'll be anywhere from sort of 500K to $1 million generally on the first check.
Yeah.
But all in on a company can range up to, I think on some of our companies we have almost 8 or 9 million invested now. But the first check will be 500K to $1 million.
Okay.
Typically.
Yeah. So you help build the companies up from the pre-revenue stage or post-revenue?
Yeah, generally, especially with medtech, there'll be pre-revenue when we invest. I mean, we've gone as early as taking, tech or IP that's in an institution like a university, like we're in here, and assigning that into a new corporation, and that being sort of the time when we first invest. So I think Flowsonics is a good example of that, where it was a brand new company basically that we were investing into.
Yeah. So you're an associate, but you kind of have like an analyst role within there where like,
right,
you kind of predetermine which kind of companies you want to look at. You have a lot of autonomy there when it's like a lot of clout when it comes to like which companies you want to look at, which companies.
I don't know if I'd call it clout.
No?
But, I mean, our role does, like, it begins with sourcing. So we do everything from, going out to different incubators, coming to the hub, coming to DMZ, BMZ, CDL, going to Hamilton, going to Ottawa, generally focused in Ontario. But, recently we were out in Minneapolis. We went to Medical Alley, went to, visited Mayo Ventures guys. And the idea is just to meet as many companies as possible and find out, what the newest or greatest tech is. I mean, generally when we meet a new company, the first two things we try to kind of verify for ourselves is market size and competition. So we want to know, is the problem that these guys are trying to solve big enough for us to really want to participate, right? And then second, who else is doing this? Is this really the best answer to this problem? Yeah. So like one of the things I was surprised to learn is like how lean the management team of a VC fund kind of runs, right? Like you guys have support structure, but generally about 5 to 7 people kind of run the fund. Right? Absolutely.
Like $100 million fund, right? How does a VC fund work? Like how is it structured? Okay. What's the thought process there? Like,
so I can tell you about our fund.
Yeah.
So with our fund, Sam, if again, is the managing partner. He's the ultimate, sort of stakeholder. He's the one that has to say yes or no to every deal. But by the time it gets to Sam, we've already done quite a bit of work in preparing it for him to look at, right? Below Sam, I guess, or maybe, I don't know how to describe it, but let's say there's other partners or principals at the fund as well. So, Mike Aaron's getting a lot more involved now. Joel Finlayson is another partner at the fund. We used to have 2 principals, Ollie and KJ. So Ollie and KJ are both now CEOs at our portfolio companies. And so they've decided to take on a more operational role and get really hands-on into a business and, take it from sort of that Series A stage where they're at right now to hopefully, a great exit in the future, right? And then there's the associates, so myself and Billy. And then we always have sort of a rotating flow of analysts, usually interns from Waterloo, Queens, Ivy.
That's great. Like one of the things like I can appreciate about iGan is you guys have a very hands-on approach with your portfolio companies where you get in, get your hands dirty, you help them do the kind of work that they need to get done sometimes. And especially with like healthcare tech companies, there seems to be a lot of knowledge gaps sometimes when these are research-heavy kind of companies, and now they're trying to commercialize their research or a project. They get into roadblocks into how that looks, right?
So I'd say where we help the most, at least at the associate level, where we help the most is on financials, budgeting, making projections, working on decks for new investors, sales decks, things like that. Where they help a lot at the partner level is on biz dev. So, Joel, for example, he spent the last 10 years of his career in Saudi.
Yeah.
He's got really strong connections in the Middle East, and he's over here commercializing, a lot of our companies, whether, think research, Esight, out in the Middle East.
Yeah.
So signing massive contracts to sell, tons of software devices across that whole region versus, the way Billy or I might be able to help on BD would be kind of helping make intros to single institutions, right? Not really at that platform level.
Yeah.
And so this is where I think iGan adds a ton of value in being an active investor. We have a board seat in every company. We're focused on driving sales as well as cutting costs. And every dollar we invest doesn't just come with the dollars out of the fund, but often comes with matching dollars from a syndicate of investors that we typically try to handpick. So we look for the most strategic investors in our sort of pool that won't only invest money, but will also invest time and their connections.
And potential resources as well if they have.
Exactly.
Yeah. So these are your current portfolio companies right now. I believe you have about 19 portfolio companies?
4 exits, so
Four
now
exits.
19 left active, but yeah.
Yeah, so this is from your fund one, like your first
Yes,
initial
fund 1 and extension. So
And
that
extension.
fund 1 and extension in total now is about 100 million. And we're hoping to go out to market later this year, raising fund 2.
Perfect.
Yeah.
Awesome. So how do you predetermine what kind of companies you work with? So these are all, again, med tech kind of companies, but they range in the kind of problem sets they solve, right?
So I say it kind of falls into 3 buckets. So there's the medical devices, and that's your like traditional med tech. They're gonna pursue FDA, hopefully sort of class 2. Then there's the healthcare IT companies. So think research or OrbCare, Brain Effects, those types of companies. And then, we have from the past sort of these B2B SaaS, more traditional SaaS companies like Fineo, FlipGive, Limelight. Going forward, a third sort of area of focus for us is definitely going to be in using sort of AI to complement both medical devices and healthcare IT. So the way I see AI complementing our medical device companies is basically if you think of a company like Exact Imaging, they're producing a completely unique modality of imaging that nobody else has, that data, right? Now that these guys have a completely unique data set that they have doctors, basically sitting there day to day labeling. Well, now you have a labeled unique data set that you can use to create, whatever algorithms they use to hopefully in the future now help doctors in that labeling. So the next time an image gets made, some software can hopefully point the doctors to the right areas to focus on, get them looking in the right places, and then kind of nudge them towards the right answer. And I think that's the way AI is going to end up kind of fitting into healthcare. It's not going to be that AI is going to replace a doctor and say, it's not that we're not going to have radiologists in the future, right? It's not going to be that easy.
Yeah.
I think it'll be rather helping a radiologist make the right decisions. And we're still a long way from even being there, right? Because basically regulatory frameworks, the way they're set up is if software is going to provide a diagnosis, you're looking at a much tougher regulatory pathway than if you just have software that's giving you tools.
Yeah.
Yeah.
That's interesting.
Yeah.
So most of these companies pretty much are creating tool sets within the industry to further augment the ability of human players.
Yeah.
Right.
Exactly how I describe it. I mean, one thing that we say we look for is companies that are adding information to assist decision makers. And whether that's clinicians or nurses or radiologists or other people behind the scenes, it's healthcare IT and device companies that are creating information to assist decision makers.
Yeah. And I think one of the most consistent pain point that most healthcare tech companies, healthcare facilities face is, I think, EMR integration.
Sure.
Right. So all these different scanning tools and different technologies made by different companies don't really communicate together.
Right.
Right. How does that look for the industry? Like,
I mean, we're looking at some companies that are hopefully trying to tackle that problem. So companies like MedChart and even OrbCare to some degree, if you think research, they're helping kind of bridge the gap on these issues, right? They're trying to become a platform play within institutions like this that help sort of take in data from all sorts of different sources and then provide you just the output you're looking for.
Like with the healthcare tech, is there like a holy grail like people are looking for right now? Like every industry kind of has like a hype field, right?
Sure.
Right.
I wouldn't say we have a holy grail that we're after. There's no specific, hey, this is it. This is the be all end all. We're looking for this one company that's going to do everything. Just because I can't imagine the rollout of that type of technology in our system the way we have it today, right? I mean, even when Ontario tried to roll out like a single EMR database for everyone's medical records, I don't know how long it took and how many billions have been spent or whether they even have a finished product today, right? I think it's instead going after specific answers to specific problems and building up upon that.
So just how scalable are these kind of companies when like infrastructure and regulation is so put constraints to their growth levels, right?
Yeah, so this is sort of the double-edged sword of kind of being in a single payer system like we have in Ontario. So the positive side of it is single payer system. You only have to sell to this one group. If you can get them on side, you're in, and one by one you'll be in everywhere, hopefully.
Yeah.
But then you look at the U.S. and a lot of our companies are outselling in the U.S. as well. But that's a whole different system. You're facing a lot more competitors, and you're selling to a lot more people who all want different things. So you kind of have to choose which battle you want to fight, or if you have the capacity to, and you have the right sales strategy, hopefully you can fight multiple battles at once, right? So you take a different version of your product perhaps to the US because you know that you're selling to maybe SMEs or smaller health systems. And so you might be able to sell something that's more modular out there versus what you're trying to sell in Ontario is a complete enterprise solution. And again, that's depending on the type of product you have and the type of customer you're servicing. There's no sort of one answer fits all, one shoe fits all approach.
Definitely. Yeah. So let's talk about a few of the portfolio companies you guys have.
Okay.
Like Brain Effects was super interesting because they won last year's Pitch to Heal.
Pitch to Heal,
right.
the competition.
$250,000 pitch competition that you guys throw now.
We have our second annual Pitch to Heal coming up November 7th at the Four Seasons Hotel.
That's amazing.
So we're getting better every year, and we're excited for this one.
So this is a $250,000 pitch competition, and you run it twice a year or once a year?
Once a year.
Once a year?
Yes.
And like, what's requirements here? I know there was a beta kit press release.
Let's pull that up. That's got the, scroll down a little bit there.
Yeah.
So we are looking for 3 emerging health tech companies with groundbreaking technology to pitch at the event. I mean, there should be a link on this article that will take you to the application page. And if you can't find the application page, you can always apply at info. Just send an email to info@iganpartners.com, attach a deck, and you're good to go.
Okay. Yeah, just attach it.
Gotcha.
Yeah. So what kind of companies are you hoping to hear from?
Yeah, so actually last year when we ran the event, we did a survey of like 10,000 Canadians, just trying to ask them what are their biggest concerns, like what are they worried about, where do they think health tech can help address some of their concerns, right? And what we came up with the top 3 answers were cancer, mental health, and diabetes. And so that is sort of a bit of a bias to when we're looking at companies to filter for this competition. We're going to try to answer, hopefully there'll be a company for each of those 3 areas. So we'll pick one cancer company, one mental health, a company that's addressing mental health issues, and one company addressing issues with diabetes.
Awesome.
Yep.
Okay. So last year, like when I came to you were kind enough to invite me over to the Pitch to Heal event. I had a great time there. Met a lot of great cool companies, met some of your investors, some other key industry players. But really, I mean, the highlight was BrainFX, right? They kind of stole the night with the pitch.
Yes.
Right? It just, everyone kind of like just after their pitch is done, the whole room kind of held their breath because they're like, okay, everyone kind of gets it.
Absolutely.
Can you explain BrainFX a little bit and what exactly they do?
Right. So BrainFX created basically a cognitive assessment, electronic cognitive assessment that they sell through their platform.
Yeah. There we go, Sam, right?
Yeah, that's Sam. That's the check. There you go.
Yeah,
that's
there
the
we go.
moment right there.
So
Sam,
it's real, guys.
It's crazy. Beauty. So yeah,
cloud-based mental
answer.
health digital platform, okay? And it was built by Tracy, right?
Yes, Tracy Milner and the team there. They're based in Pickering right now. So Tracy herself was actually, a clinician. She's, servicing patients that are facing sort of mild to moderate brain disorders. And she realized that they needed a tool. They needed something that wasn't just going to replace the MOCA, straight up, like not just take a paper test and put it on an iPad, but rather create an assessment that is also going to test your everyday functional tools. So they've got things in their tests that are like checking email or creating a to-do list, things that you need to know how to do every day anyway, but now let's build it into an assessment so that we can see, hey, are you suffering from a concussion, or is something affecting the way that you would build a to-do list or you would check your email?
So how did they set a baseline on
Well, I leave that to the scientists to figure out, but they've done a lot of clinical validation, and they do a lot of research in building these tests. So.
Cool, yeah. I mean, one of their chief backers was, what's his name? John Francis.
John
Fraser
Francis,
Capital.
Chen Fong. She's got a lot of great investors on the cap table prior to us investing, and Sam's he's kind of built into the network here, especially through CDL. So it's always helpful to see that other investors that we believe in or other investors that we trust are also co-invested in these companies with us.
Yeah.
So it makes a difference for sure.
100%. I mean, one of my takeaways from that night was just hanging out with John Francis and just talking to him and listening to him talk about his life. I mean, he studied radiology, right? And then from there went into iBanking and became a VC. Right. And I was talking about, what was that like? What was that journey about?
Yeah.
And he was explaining his life, but like his main thing he was talking about is like his investment strategies, how he works with companies.
Right.
He picks he rather pick up one or few good players that.
Sorry.
Yeah. Sorry, some background noise there.
Yeah. What's going on? Yeah.
So he'd rather pick a few companies that he prefers, but he always goes in it with a few other friends. Right.
Right.
So he always invests with other people.
We generally always also build a syndicate around every investment we make. It's wild, the stories that you hear from a lot of these investors, even our backers, like our LPs, it's like everybody's got a unique story. Like there's no linear road to becoming an investor or being an entrepreneur. I think that's probably one of the most fun parts of my job is just being surrounded by passionate, interesting people every day. And you get the sense of it. Like when we do like demo days where we, sit down and meet like 10 companies, it's just like the time flies by, right? Like somebody comes in, they're telling you about, what they're dropping everything to do, right? Like they're not spending time with their families, their wives, their children, because they're focused on building this. They believe in it that strongly, right? Getting to sit through, hundreds of meetings like that, I realized like those are the guys that eventually become the VCs. You know what I mean? Like they're the entrepreneurs that will be successful, that will make the money to then go back and invest and continue to grow the ecosystem the way they do. Yeah,
I mean, until I spoke to John that day, like there was a sentiment in the market, like when money, the flow of money, right? Like it stays within a certain few players, and like everyone kind of cycles amongst themselves, and there's a negative connotation to that. But speaking to him, he was like, no, like you want to co-invest with people you understand and know with, that can provide resources to these companies, and you have a proven track record with, and there's a shared value in that kind of sense. And he kind of spun it in a different way from the equity side, like how valuable that is for both the investing side, how to secure it, but also for the innovator.
Yeah, I used to think the same thing where it was like, oh, like how unfair is that? Like you have to be this accredited investor who, you know, happens to be boys with this other accredited investor to find out about these deals. And then these are the deals that get 50x returns. And the rest of us, you know, plebes got to invest in the stock market and, you know, hope for 7% this year. Right? It's like, oh, well, actually, though, that's not what's happening. It's they work with people they trust. And, you know, the OSC has these regulations and guidelines around who's allowed to invest in private companies because of the type of risk that you have to take in order to invest. And so if you're working with other people you trust who are also capable of taking those risks and they can provide a lot of value to help grow the businesses that you're investing in, well, then it's just a no-brainer. It's not that you're just investing with your friends. It's that, yeah, you know, you're working on companies together, you become friends. Like it kind of happens naturally. So yeah, my viewpoint on that has shifted a little bit too. And you can do pretty well in the stock market even if you can't invest in private companies. Yeah. So you got to do what you got to do. Yeah.
No, absolutely. And I think the second thing he also said was talking about like risk, right? I mean, in Canada is known for being a very conservative when it comes to like the investments made, especially with the VC world. Like, I mean, there's a reason why we don't have the kind of unicorns or the growth rates that American companies do, because the capital doesn't flow it easily. Yeah. And you know, it's almost seems a negative, especially coming from.
I mean, we're the only early stage health tech like investor at the stage that we invest in in Canada. Nobody else is looking at the companies that we're looking at, and so I mean, in the U.S., like there's a lot more capital feeding those types of businesses. Right. But the great thing about Canada is we've got. I don't want to say it's exclusive access. It's that there's a fight to the top, right? Yeah. So the companies are really pushing themselves. They're bootstrapping harder. They're really making their way. They're showing how profitable they can be, just in order to get a Series A investment. Whereas you know companies in the U.S. are ready to burn way earlier.
Well, VCs want them to burn too, right? Like they tell them.
So when we invest, yes, you know we expect them to burn, but we also want to make sure that they are capable of being profitable. Yeah. We aren't funding, you know, like WeWork, Uber, roads, you know, like just burn through your IPO, raise more money, burn more. You know, it's like, no, we'd hope that eventually these companies are going to be profitable. And so we always want to make sure the unit economics are there for the company to be profitable when they're ready to sort of slow down the growth stage.
Yeah, and tying back to John Francis' last sentiment, like I was asking, like, you know, why aren't like investors here, like, take more risks? And he took it, and he's talking about, and he just put it into one segment, right? Like he's like one key value point. Yeah. He's like, well, like you don't go chase the moonshots. That's how you lose. Right. You want to hit the singles, the doubles, the triples. That's it. Right. The consistent returns.
Like playing baseball. There you go.
Right. Like you keep hitting those returns, and you keep consistently improving results, not just to make capital for yourself, but all the key value players in the room. They're co-investing with you. The company's working with you. Right. So you show consistent. It's more important to show consistent returns, so more people want to work with you in the end of the day, and that's how you build the value add.
It's a relationship business, you know. So you want to build strong relationships with everyone you work with, and absolutely, you know, home runs are great. Yeah, we're not saying no to home runs, right? But like you said, you got to hit singles, doubles. That's how you win the game at the end of the day. So that's one thing iGan also kind of takes pride in, is we're not a spray and pray VC. We aren't making 90 investments of small amounts in a year. We're out here basically investing 3 to 5 companies a year. We're getting very actively involved in each company, and we haven't lost on the fund any companies yet, and pretty proud of that, right? Like a company like FlipGive that a lot of people sort of lost faith in, they just raised a huge Series A with great VC focused on marketplaces called Framework Ventures. The FJ Labs, Fabrice Grinda out of New York invested in that round, right? Like that's something to really be proud of, where 2 years ago people didn't want to invest in FlipGive at all. We're calling everybody on the street, asking them if they want to participate with us in a bridge round. Yep. And we're not getting calls back. And then now people are calling us up to say, hey, is there still room to participate in that FlipGive round? And
Yeah, so like
And then
FlipGive
go to
was
their
being around.
website.
Yeah. So they've been around for about 10 years, you said, right? Like they've been before your company for 10 years?
Yes. Well, I think iGan first invested in FlipGive probably back in 2012, 2013, and the business pivoted since then. And iGan's been on the board since then and brought in, maybe not brought in new management, but brought in consultants and brought in a lot of people to help work on the business and do things.
So what they do is like now what they do apparently is sports fundraising and a marketing platform that allows sports teams to raise funds and brands to acquire customers.
That's right. Yeah. So they basically realized that, especially in the U.S., you'll see kids sports, it gets really expensive.
Yeah.
I mean, in Canada, you can imagine if you're on a hockey team, you got to buy equipment, you're going to travel with the team, stay in hotels, go to restaurants. So FlipGive basically realized like right now the only way to fundraise for that, or the way kids are fundraising for that, is like selling chocolate bars.
Yeah.
They're like, all right, instead of going door to door selling chocolate bars, why don't we create a platform where you just get your friends and family to shop on things they would normally shop for, but instead they shop through FlipGive. And FlipGive isn't taking a markup on Walmart or whatever. They're just giving you a link. So you go through FlipGive, you go to Walmart, you buy the stuff you would regularly buy. They've got Amazon, they got Walmart, they got basically every brand that you'd regularly shop at.
Okay.
Through the FlipGive platform, and everything you buy gives back to the team and the player that you're supporting.
Is that through like Amazon, like affiliate links?
Yeah, basically stuff like that. I mean, it's things that other people are doing. So you see Ebates, you see other guys doing this.
Mm-hmm.
What FlipGive realized is a lot of these brands want to support sports teams and youth, so they're willing to give back at much higher rates than they would on like Ebates, where you might get 2% back or 1% back. On FlipGive, you might get 4% back, 5% back. I mean, I know some brands are giving as much as 10 to 15%, and the reason they want to do that is because these are great loyal customers. These are access to families and youth. And we basically at iGan realized this really early on. We're like, all right, that core fundamental investment thesis hasn't changed, right? So if something's not working and they're pivoting something around the business to focus in on that investment thesis still, then of course we want to keep providing capital to support that, right? Like the right team is in place, the right software is there, and the market is reacting positively to it. So, if all it takes is a little bit more capital to get this thing to the moon, then let's do it, right? And I think we made the right bet 2 years ago when we decided, yes, we're gonna, help them restructure and pivot and continue to grow, because now the Series A is taking off. So
Yeah. That's great, but so they pivoted away from a healthcare tech company. Is that how they initially got funding from you guys?
No, so back in the day, iGan used to support all sort of B2B SaaS companies.
Okay, so it wasn't a
Sort of,
specialized
yeah,
healthcare tech fund.
It was medical imaging and B2B SaaS. And the reason medical imaging was in there is because Sam's background is in medical imaging. So Sam has had ultrasound company exits to Fuji, Sonosite, Visual Sonics. So,
Jeez.
yeah.
Didn't understand that's like a whole business model there, right? Like supporting these kind of specific niche companies.
Oh, exactly, man. Medical imaging is huge.
Yeah.
Huge industry.
Yeah. That's great. Any other cool companies?
Oh, I mean, every single one of these companies has a cool story. We could talk for days about each one. RNA Diagnostics is a really great one as well.
There was one that demoed at Pitch to Heal, the Esight, was it?
Esight is another great one. Esight is helping, return sight to legally blind
Is that a
people.
portfolio company as well? Or?
Yeah, so they're right there at the end there.
Oh, yeah.
Esight. And so, I mean, that's always a crowd pleaser because it's funny that the pages are...
It's all right.
So I think our website is getting updated. Things are under construction.
Yeah.
But we can go to the Esight eyewear website and you can check them out. Yeah, that's the one.
Electronic glasses for the legally blind.
Right.
So this was a really cool one because at the Pitch to Heal,
I mean, every year iGan does, so in the past, prior to Pitch to Heal, we used to do October Tech Fest, and we would basically donate an Esight device to some, lucky child, usually, at the event by selling raffle tickets at our event and getting other support from our community partners and investors. But it's a tearjerker moment at every one of our annual events when a little kid comes up and gets to see for the first time
It was insane. Like I saw that
Yeah.
at that event. Like you guys picked, I think 3.
Was it 3?
I think 2 or 3 people. Yeah. So back to how this works. Basically, for the legally blind, it's people who are not completely blind but like are impaired.
Right.
Right. Basically, cannot see.
Usually, it's they have some condition that's getting rid of their central vision. So they have central vision loss, but they still have peripheral vision. And so the glasses basically use prisms and I don't know, other great physics and technology to take advantage of the fact that they still have peripheral vision and sort of fill in the gaps, let them see again completely.
So from what I understand it from one of their, I think the founders or one of the key component teams there, members there explained to me that what it does is pretty much it's a series of cameras, right? Mm-hmm. That takes high image pictures of their environment and then like literally shoots it into the eye, mm-hmm. right? And just pretty much like gives it enough information. So if a certain part of the eye can actually still see technically, mm-hmm. right? It shoots the full image through prisms into that image. So through that one part that's actually still working, you can actually holistically see, right?
Something like that.
Something like that, yeah. Right? So giving vision back to the people who physically there is some capabilities there, but just magnifying it.
Exactly. I mean, this is again, this one example of, of the many companies that we have. Exact Imaging. So they created, a new medical device for identifying prostate cancer. And, actually one of the employees at Exact, while like they were just running tests, like to try out the device, they're making, I don't know, a new model or something like that. Mm-hmm. And he was able to catch his prostate cancer early because of that.
Yeah.
Like, how unbelievable is that? Like, some of these companies are saving lives every day, and that's where it goes beyond just investing for dollars, right?
Absolutely.
Like, investing in healthcare and med tech. It gives you a reason to wake up in the morning and really give it your all.
I noticed that from talking to people at Esight. Like, every one of the company, it just seems so like satisfied, like they're doing something so meaningful, fulfilling, right? Yeah. Like they're just driven by something more than just like creating a regular product or service, right?
Absolutely. Yeah. I mean, RNA Diagnostics is another company we've got that. So RNA, what they do is they created an assay to test for breast cancer, but basically after you start chemo, right now, the way it works is doctors have to bring you in maybe after 4 months of chemo to get imaging done to see mm-hmm. if the tumor has shrunk. I don't know if it's 4 months or less, but doctors will tell you you have to go through several rounds of chemo before you're able to really see any change. Well, these guys developed is an assay that you take a biopsy of that mm-hmm. tumor after 1 round of chemo, and they can tell you if it's working or not. That's magical. I mean, you're able to save lives. You reduce the toxicity of putting someone through chemotherapy that isn't working, and then you can move them on to a treatment that might actually work instead. Mm-hmm. So this is, one of the things that we see is we're moving towards personalized medicine, and people are going to start getting these drug cocktails and these treatment plans that are catered specifically to them. And we definitely think these types of diagnostic tools and these assays are going to be so important for actually applying that new treatment pathway, because you need to know whether the cheaper treatments are working before you can move them on to something that's more expensive. So
great.
Yeah, we are excited about what RNA Diagnostics is doing and helping them fund right now this large multi-site, multinational. They're in 5 countries running a trial of 600 plus patients called Brevity, and looking forward to getting some results from that later this year.
That's awesome. I mean, that's one of the main things, like I realize now talking with you, like the function that the venture capital space provides. It's like helping companies that are providing real solutions in the market space. You guys are identifying these companies which have the ability to actually to perform the solutions that they're meant to be doing. Right? You guys are the filter base.
Banks aren't giving these guys money.
No.
Like, there's no way anybody out here is raising money from RBC. You'd have a hard time opening a restaurant trying to get money from RBC, you know what I mean?
Yeah.
Forget about these types of risky, really interesting technology plays. So this is where we really got to dig in, and we rely heavily on our clinical advisory board and a lot of due diligence partners to mm-hmm. help us kind of make sure that we're backing the right scientists and the right technology.
Yeah. Yeah, I mean, and one of the things I've been following is also like the growth of the VC, like the VC companies, right? Themselves, like how many companies have come up. Like like Canada's still pretty new when it comes to the financial support structure for the innovation economy, right? Like like OMERS was the first real VC firm.
Okay.
Right? Am I correct there? Like that really started off here?
Maybe, I don't know all the full details of the history of VC in Canada, but yeah, OMERS is definitely a large VC here, and they've been around for a very long time. John Ruffalo, I think, started that group there after leaving Deloitte and joining OMERS way back when. And
I remember like they got a lot of flack because OMERS handles the Ontario Teachers Pension Plan, and right?
Well, they're the municipal, I think.
Municipal?
Yeah.
Oh, was
municipal
it Toronto?
pensions.
Toronto Teachers Pension Plan?
That's a different.
Different?
That's a different pension plan.
Okay.
OMERS is the municipal one.
It's the municipal one? Okay. Never mind.
But still, yeah.
Yeah. So they're running a pension plan. They decided to run a VC fund out of it, and people are like, you're basically betting with like pension money, right? Like.
Right, but I mean, so a lot of these, like, right now, I mean, OMERS still has their funds that do, invest in a lot of different things outside of VC, right? Yeah. They allocate a small portion of their overall capital. I mean, I think that's generally true for any portfolio you're constructing, is you don't want to be over allocated into any one industry. So you choose how you want to split up your pool of capital, and generally maybe 1% to 2% go to these sort of alternative assets, and venture is part of that. So I'm sure they've got really smart guys working on portfolio construction at all of these institutional players that are choosing to allocate to VC, that are making sure they're not getting too much risk exposure into the venture space. That being said, we haven't taken any institutional capital yet. We're working strictly with family offices to date. And we're still able to raise $100 million without any institutional money, without going to pension funds and banks and you name it. So whether or not the fund of funds are ready to invest in our fund is yet to be seen. But there is capital out there that isn't only from pensions and institutional players. Like, there's a lot of capital available in our ecosystem through private investors, basically.
Absolutely.
Yeah.
But I think the growth of that space has been really in the last 5 or 10 years, really, right?
Yeah.
Previously, there wasn't much players in that space.
Yeah.
But now we're seeing more and more.
When you rely on institutional capital only, their idea of risky is very different from, like a typical US VC's idea of risky, right?
Yeah.
Like, institutional investors typically only come in at much later stage when a lot of the risk has been taken care of by the smaller investors who stuck it through and put in money early and help build these companies. Yeah.
Like with Silicon Valley and like how the VC space grew there, it was mostly founders of companies that exited in early stage, in the Valley era, right? 1.0 before.
Some are that, and some are guys like, whether if you're an exec or you're a high level, senior manager or something at some of these large tech companies, you're making enough money each year to bank away quite a bit, and you can become an investor in a few years of working a job like that. I think that's something that we don't have as much of in Canada because we don't have as many large tech companies that were based here. I mean, maybe BlackBerry would have been a good example, where I'm sure a lot of the ex-BlackBerry guys have now spun out to invest in a ton of companies. Hopefully they weren't locked up in stock, in which case probably not left with much. But,
Yeah, I mean,
you get what I'm trying to say? Like,
absolutely.
whether it's Oracle, Google, Apple, Microsoft, you name it, like, they've got tons of employees that have made money over the years that now they can go out and invest and support new businesses with, right? Yeah. We just don't have as much of that here. And so, I mean, that's one example. And then on top of that, there's also just the way they look at risk seems to be very different from how we look at risk. Yeah. But one thing I do want to caution to, startups and other businesses that we meet, a lot of them say like, someone give me a term sheet for $50 million out in SF, right? It's like, okay, but if you take that $50 million term sheet and you don't hit every milestone in the next 9 months, you're never raising money again, and you can, kiss your idea goodbye. It's basically over right then and there, because they're not going to sign another term sheet from a Canadian VC after that at a $5 million valuation. No way. Yeah. Why are they going to write down their investment that badly, right? So, I always caution them, prior to taking that 50 million term sheet, think about where you want to get in the next 18 months, how much money you really need to raise to get there, how much dilution you're willing to accept, and then, who's going to help you get to achieve those goals? Like, who's actually going to be there Sunday night when you need, some encouragement or you need some help, right?
Yeah.
Is it going to be the guy in SF on the other side of the country, or is it going to be the investors down the street who you can visit any time?
Right, absolutely. I mean, that's a whole different skill set, because as a founder who's like been bootstrapping, so resource starved,
Right.
certainly you have this ability to raise X amount of capital, you kind of want to jump at it, right?
Right.
So being able to be like, okay, I don't need this right now, what I need is just this.
And you know what? If you're the type of guy who can take $10 million and deploy it effectively to hit the type of growth metrics you have to hit as a $50 million company, like right away, having raised no capital ever before, then all the power to you, go for it, right? But if even for a second you're thinking, hey, I might not actually know how to do this, and I don't know if I'd be able to deploy $10 million this quickly, having never raised money and deployed it in the past, maybe start slower, especially if you're based in Canada and there isn't a ton of competition, scratching to come up at you, right? Like if you're in healthcare, you don't have to necessarily raise a ton of money and deploy it right away in order to scale up super fast, because there's naturally some moats in place to keep you one step above or ahead of competition. And I'm not saying that's the right strategy for all companies, you know what I mean? Every company is different, and there's different strategies to deploy in different industries and verticals. I gotta throw out the qualifier.
Yeah.
But yeah, I think generally in healthcare, you're safe raising a little bit less money or raising money more gradually.
Yeah. So, I mean, within the startup space, like you see a lot of these so-called founders, right? Who go to pitch competitions and just pitch ideas that they have no intention of building, and they take capital. Like you see once in a while.
Okay.
Right? Some people win all this capital and nothing comes out of it. Right? You do see this happening with VCs too, where they would take the term sheet and not deliver.
So that's I guess a tricky question, right? I mean, anytime we sign a term sheet, we definitely sign it with the intention of investing. There are, there's opportunities to break a term sheet kind of built into the language there, mostly around due diligence, right? If we find out through our diligence that, anything that was kind of sold to us in the initial pitch isn't exactly what we thought it was, and it's bad enough that, now we don't really want to invest in this company anymore, then we might back out. But it's rare, I think, for us to get to the stage of having a signed agreement where everyone's sort of on the same page and then not following through on an investment unless something's gone completely haywire in the diligence process.
No, absolutely. Yeah. So my real ask is not just with your fund, with other funds in general. How do you prevent charlatans who will come and say, I'll take that $50 million and I'll go do X.
Yeah, it's hard. I mean, you gotta do hopefully enough diligence to avoid the fraudsters and the charlatans. There's guys out here who do all kinds of stuff.
Yeah. Definitely. So awesome, man. So now you've been in the VC world for a while. I think I asked you this as well. Would you spin out and do your own startup? Would you?
I don't know.
Would you go out and work in a startup?
Right now, I'm loving what I get to do. Being an active investor means I get to have some of that operational experience that I would get being at a startup. So I don't necessarily see a reason to jump out into that yet, right? I'm still learning a ton every day, and the fund continues to grow and our opportunities continue to grow. So, I mean, I just feel blessed and lucky to be in the role that I'm in and actually love it. So it's I don't know. I don't want to change any of it yet. Not for the foreseeable future. But that's what I said at that number before. So I don't see. But I'm not trying to make any moves.
Are you enjoying the growth learning curve you're on right now?
It's still exponential every day.
I mean, I would imagine just having the title of being part of VC for opens a lot of doors for you to even access people in general. Right?
Absolutely. Being able to, just even for doing diligence on companies, right? Being able to reach out to top professors at universities, top executives at corporate, at companies, and be able to talk to them about the technology or just even the business, what they're doing and where they see, risks for technology entering and disrupting them. it's like, yeah, like getting to have those conversations and learn from these people. I would not have access to any of those guys if I was stayed at, any other sort of corporate job that was just another guy kind of working at a place, right?
Yeah.
Like the title of VC definitely opens a lot of doors.
Definitely.
Yeah.
Now, like lately, we see a lot of like high net worth people opening their own funds.
Yeah.
I think it's mostly because due to technology, it's cheaper than ever to run a fund. So rather than have like, if you're a high net worth people, you're an actor. Ashton Kutcher is famous for having his own fund, and like Will Smith is now investing in funds, right?
So one thing I'll say about that is the real value out of the fund is not that there's a vehicle that's investing on your behalf. I think it's sort of the team that's out there making the investments, right? If you're a high net worth individual, you might not want to go through the effort of meeting 100 companies, picking one, doing the diligence to find out, if the tech that they've created is real and if the impact they're going to have is substantial, modeling that and trying to figure out whether this is the right investment at the right price. I mean, if you really want to go through all that effort, for sure, right? But if you're a high net worth individual, like you got a boat and you can go to Mexico, and just do that. Right? I guess if you enjoy investing, then for sure.
I think what's more going on is that rather than get their money actually managed by somebody else, right? They're saying that, hey, we can put my money here, hire 5 people to manage it, and have like an investment firm that I can now invest in companies, right? Like you see Serena Williams doing this, ball players, right? Athletes.
Sure. I guess the benefit to somebody doing that would be, they're still technically paying that management fee because they're paying all the staff to manage the capital. It'd probably be on the performance fee side of things. So the sort of typical 2 and 20 model means you're getting a 2% management fee, and then 20% performance fee is the carry. So that's, once you've returned all the capital, probably plus some designated like hurdle rate return. Any return above that, 20% of that return goes back to the guys who are managing the capital, right? That carry. But I imagine even at a fund like Ashton Kutcher runs, like the guys running the fund probably still want that 20% carry. So I don't think they're saving any money on the cost side of it. It's probably just the clout. Ashton Kutcher just wants to be able to call himself a VC, I guess. I don't know.
Yeah. And so that's what I'm trying to figure out. Is there real value add that they're actually making more capital here?
Or high net worth guys? Yeah. They could be. I don't know if they're actually returning more money, if they're actually getting better returns, or I haven't actually worked with any celebrity funds. We almost got Dikembe Mutombo into a company, but he didn't end up working out. He was flying around too much. So
wasn't there a VC fund you're working with recently, the music one? What was it called? It was an entertainment-based fund run by Nas.
Queensbridge VC.
Queensbridge.
They co-invested in MedChart with us.
Okay.
So I unfortunately didn't get to meet the guys from Queensbridge, but I wonder if they actually get to hang out with Nas or how involved Nas is in making investments. It would be so cool to get to meet some of these guys when we co-invest, but we sold one business to the Chan Zuckerberg Initiative. And so this was prior to me joining iGan, but apparently, Mark Zuckerberg was here in Toronto, but no one from iGan actually got to meet him. It was that he was in the room, he signed his paperwork, and then he left. And then later that day, iGan was in the same room and signed the paperwork and left. But that's pretty close. You breathe the same air. But it's funny. A lot of these celebrity funds, I think it's good for the community because it's adding more capital, it's adding more exposure. That's all positive, right? So, whether they're saving money or whether they're getting better deals by doing it themselves, I don't know. But it's still all positive. Like generally, VCs work together, especially in Canada. We're not too competitive on deals. We're not fighting each other off. So, if there's a round that we can both participate in and we both add value, it's all the power to us, right? Let's all work together.
Yeah, so you rather like co-invest and work together on pumping that portfolio company up.
Oh, absolutely.
It works more.
Especially if we're all active managers, it's like, hey, look, it's rare to get to a situation where there's too many cooks in the kitchen. We're all adding value to these businesses. So let's all just take part and keep adding value.
Definitely.
Yeah.
All right. So where do you see, like, again, going forward, and then you're raising a fund too?
Yes.
Right? Any particular companies looking forward to that, or you're going to replicate the model you're working on?
I think right now the idea is to continue with the model we're working on, so replicate the existing model, just more capital and more companies. I mean, hopefully, eventually, we start to look at later stage companies as well. So maybe even taking on Series A to Series B rounds, right? We're going to continue with the strategy of helping commercialize our businesses abroad. So taking them to South America, Mexico, obviously the US, out to the Middle East and to China in coming years. So we're signing a lot of partnerships and working with a lot of new groups of investors and kind of commercial groups to get that going off the ground.
You guys going global?
Yeah, I mean, we already are. We've taken so many of our companies out to, whether it's Europe, the Middle East, China, Mexico, South America, the US. This is stuff we've already done, but now it's building in the processes to make it super repeatable.
Yeah. I mean, we see generally a lot of this when like VC funds, like they move more into later stage funding. It's safer.
Sure. I mean, I wouldn't say it's because it's safer. I think the reason that ends up happening is because as you're successful in what you're doing, you end up raising more capital. As you raise more capital, it's harder to deploy that by writing, $500K million checks. Imagine there's a day when we raise $500 million. We're not going to just being able to spend that. You're going to have to start investing later stage because, there's only so many of us. And if we want to stay an active investor, we can't really take on many more companies, right? So if we're going to invest in the same number of companies, but we're going to invest 5 times the money, we've got to be investing larger check sizes, basically. So I think that's why it ends up happening naturally, that investors start looking at later stage deals as they grow. And then also, if you think about our portfolio, as we grow, our companies are going to grow. And, now instead of having a lot of Series A or a lot of seed companies, the portfolio is going to be mostly companies that are ready for Series B, C, D. Yeah. And so that's just naturally going to be where we fit. It's sort of how everybody, I guess, does it. And it's sort of what's happened over the years. But, ideally, knock on wood, iGan will be there in the near future as well.
Yeah, and we see this more now. Like the way I had explained to me, I was looking more into this, is that innovation goes through waves, I guess. Okay. Where a whole bunch of beginner stage companies will get invested into it, and then they'll pop off, some will pop off and become bigger. From that, capital liquidate, and then go into more other companies, and the second wave will develop based off of that. Right. I think that's very interesting, seeing that holistically with the market, how it moves. Right. But one of the key movers for that was Anderson Horowitz, I think. Early this year, they decided to move away from their VC status, turn into, I think, more of a bank, so they can.
Is that what they're doing now?
Yeah.
E16Z.
So they can do different types of financing rounds.
Okay.
Right. So that was a surprising move, and that one got me involved into researching why is that happening, right? Why are these more larger name funds becoming later stage funds, right? Is it because they want to chase and keep their current portfolio companies funded and moving?
That's part of it, I think.
Yeah.
Especially if you listen to Chamath Tia, that's what he tells you.
Yeah, that's him.
They gotta keep it. They gotta keep these large rounds growing, and these companies gotta keep ballooning.
I think it was him. Yeah, social capital, right?
Yeah, social capital, exactly. But yet to be seen with our companies whether that's the case. But I think we're building real businesses, and we're always focused on fundamentals. So we try to avoid these sort of balloony type companies that are raising money on data sets and raising money on basically things that don't actually drive revenue necessarily. So
I mean, it's fine because outside looking in the VC world and even high finance in general, you see a lot of toxicity, right? I mean, that's what the market talks about. But looking from internally, you see why.
What do you mean toxicity? What kind of toxicity?
These kind of things, the money being circled within the same kind of pools,
okay.
You know what I mean? Not to put a damper on.
It's not toxicity though, right? It's people working together. It's not like we're holding capital away from businesses in order to get cheap prices, and it's not like people are colluding to keep prices down and because that would be toxic, right? If investors are working together to say, hey, look, let's all not invest in this company until we bring this price down. I can imagine that being toxicity, right?
Yeah.
But no, instead it's hey, I found a great deal here, and I want all of us to participate in it. Yeah. And it's bringing more investors into the fray. It's not really keeping investors out.
I think in the Valley there was like rumors of a blacklist, right? Like if an investor didn't like you, they put you on a blacklist with all other VC funds, and you're burned.
I haven't seen a blacklist like that here. We're not doing that in Toronto. We can say that for sure.
Yeah, definitely.
Yeah. Yikes! Hey, that's going on out there, man.
Yeah, I mean, I think the value is different, right? Yeah. That's one of the main reasons why a lot of that capital and a lot of those companies are now moving here, I guess.
Absolutely. And I mean, Trump's policies too are definitely helping us with recruiting top talent out here.
It's funny how like the kind of trade war situation Trump brought in is actually boosting us indirectly, right?
I mean, we're getting tons of developers now that are whatever Bay Area company employees that didn't get their H-1Bs renewed or couldn't get a visa because like the lottery is crazy now. I think you cut the number of stuff that's available in half or something, right? Like, I don't know the exact numbers, but there's a lot more guys coming back to Canada that have been working in Cali for the last few years. So it's great for what we've got going on here.
Yeah, I mean, it's really been an implosion in like resources and talent and capital, everything for the innovation ecosystem, economy in Toronto to grow.
Yeah, it's exploding out here right now.
Do you see it continue to grow?
I hope so.
Yeah.
I definitely think we're on the trajectory that it'll continue growing. I mean, people are talking about recession and stuff like that. I mean, the great thing about healthcare is we're generally recession-proof, and the other good thing about VC is there's generally a time lag to noticing indicators of recession in venture capital. So if something's affecting the broader market, you're sort of shielded from that in VC for at least a few years, and it's always a good time to keep investing when market's taking a hit. That's what they say, right? Buy when there's blood on the streets. So,
yeah, awesome, man. Well, it's been great. It's been an hour now.
Wow.
We just blew through that.
Yeah. Right. Time flies.
Yeah, had a great time. Right. Thank you for coming on, and we got more into a professional stance of your thoughts on the VC world.
Yeah, I'm glad campus police didn't come after us again. So we're safe out here.
Yeah, definitely. Yeah. For those watching, they just came by right before we started.
Yes.
And just checked out what we're doing here.
Yeah.
Yeah. But awesome, buddy.
Okay.
Thank you for coming on.
Yes, thank you.
It's been great.
Good job, guys.